And welcome back to the final session of today, which is about buy-to-let and where the market is. And the final two guests are, on my left, Phil Rickards, Head of BM Solutions, and on my right, Adrian Moloney, Sales Director of One Savings Bank. Phil, first question. So where do we feel buy-to-let has landed now that we've had the first raft of changes?
Good question. I guess we've all been around in the mortgage industry for quite a long time. And I guess it's worth pausing for a moment just to reflect on the sheer volume of change that the market has gone through in such a short space of time. I can't believe it was a year ago that we went through MCD. The good news for the market is that's pretty much been and gone. 18 months of discussion at industry level as to how it would affect buy-to-let, and we've ended up with a consumer buy-to-let solution, which probably all that's done is introduce another layer of complexity to the market. Then we moved quickly into stamp duty, pretty big change for the market. That's seen a shift of business into remortgage, much less purchase business being written. So that's had a big impact on the market. We moved into the PRA consultation on underwriting standards. Yet more change for the market, seeing lenders move stress rates, and much more complexity when you break down the varying lenders and how they're interpreting PRA guidelines. And of course, you've got the big one, which is the tax changes, which again has seen a lot of change in terms of how lenders are interpreting tax change solutions. So I guess it's a market that's really resilient. It's proven to be in the past. I would probably say we've got a lot of complexity out there, but the market is probably still holding up reasonably well, considering the amount of change.
Mm-hmm. Adrian, as a challenger bank, are you finding the challenges just as tricky?
I suppose we're fairly well positioned for some of the changes that have gone on, Martin, and I guess we've only just gone through the first half of those. So come the end of September straight beginning of October, you'll have the additional underwriting rules for portfolio landlords, and that applies to those landlords that have got 4 or more mortgage properties, and that's a market we specialise in. And that will involve a much deeper dive into looking at a landlord's portfolio and the information that goes alongside of that. But yeah, we're relatively well positioned. We've been able to react to the company buy-to-lets as well as looking at those portfolio landlords and those that want to do a mortgage in their sole name.
And coming on to the portfolio, obviously we got the next changes. Exactly what is it that the government's bringing in?
What in terms of the
portfolio
underwriting rules? So as I said, it will be a deeper dive for those that have got 4 or more mortgage properties, which means that when you go for that 4th mortgage, so in theory someone with 3, lenders will have to take a greater look at the affordability of that portfolio, taking into consideration the holding costs and the tax changes in terms of how that sits. And it will mean, I guess, in today's world where you perhaps look at the spreadsheet of someone's portfolio, you have to take a proportionate look or analysis of that. And what I would expect is that over the next few months you'll start to see lenders, I guess, play their cards on how they're going to look at that.
And how do we feel? Are you getting much feedback from the BDMs on the road as to, does the intermediary, have they caught up, or are they just carrying on as normal?
I don't think they can carry on as normal. I think the buy-to-let market has become, I'm not going to say very complex, but it's certainly become more complex. And I think as an intermediary, you're going to have to do a lot of work to educate yourself, a lot of research to make sure the advice that you're giving a customer is the right advice, because there's a lot of choices out there now. Be it tax changes where you've got lenders that have just gone for a one-size-fits-all. You've got affordability models. You've got different interpretations under that, whether you use 5-year fixed rates to stress at. It's become a very, very difficult market. So I think advisors have got a tough gig on their hands to bring themselves up to speed with their knowledge.
And is there anywhere that advisors can find a clear explanation of what all these changes are?
I think in terms of tax, one of the things I'd advise a mortgage broker to do is to actually go and strike up a good relationship with a tax specialist, somebody that really knows their trade. And that could be for referral purposes, so they could get the customer to talk direct to the tax advisor before they take on the mortgage advice. And it could be to bring the advisor up to speed with their own knowledge. In terms of HMRC support, there's a good government website. And there are some lenders out there that will talk to you about tax. But I think on the whole, it's important to realise that lenders are not tax specialists. We're providing a mortgage solution. And I think it's up to advisors to go and educate themselves. We'll support them through that. A good example would be for our tax change solution we deployed ourselves at BM. We went on the road and we educated over 5,500 brokers face to face on the upcoming changes. But it was very generic. It has to be that way.
And are they asking you lots of questions around the edges, though, or are they quite happy to just get the specific on yourselves?
Very happy to get the specific stuff that we were going to do, and then the generic stuff around what was actually changing, which we were comfortable giving them that knowledge.
And Adrian, have you got any advice, or have you got any guides that you've brought out?
Yeah, I mean, we produced a guide in association with EY last year that was very well received. I guess my advice to brokers is that unless you're qualified, you shouldn't be given tax advice. But I think, as Phil alluded to there, tax advice and mortgage broking and buy-to-let almost certainly goes hand in hand at the moment. And there are a lot of changes for brokers to take into consideration. And what you want to make sure is that your client's well positioned and well advised before making the decision in which route they take out their buy-to-let mortgage.
And does that mean then actually having those third-party relationships with accountants, with tax advisors, is even more important than it probably was before?
Absolutely, and I think there's a great opportunity there, as Phil alluded to, in terms of cross-referrals, and probably one of the first things that you want to put any client to now with the tax changes there is, have you had sound tax or accounting advice? Certainly what we see at Kent Reliance when we deal with some of the bigger portfolio clients is that very much they've gone to some of the bigger accountancy firms for advice before deciding what they're doing going forward.
So it's not cheap moving forward then, potentially?
Absolutely not.
But I'm guessing you can add that in as part of your business accounts?
Yeah, I guess you can. And actually, I think what you're seeing now is landlords looking to the longer term. They may be taking some, pain up front in terms of some of the costs that they're doing at the moment. But actually, in terms of buy-to-let mortgages, they've never been as cheap, whether you're looking in sole name, and certainly with the amount of competition in the limited company market. I think there's 15 odd lenders out there now offering over 100 products. Actually, it's become a lot more competitive and the pricing's more keen.
And do you think limited company is the only viable solution?
So is
that tax advice?
That would be, and I'm not an accountant. So is it the silver bullet for everything? No, it's an option. What we certainly see at the moment is higher rate taxpayers purchasing are looking more and more into the corporate vehicle or the company structure. Is it right to shift the portfolio across? Of course, there's a lot of cost associated with that, and of course, that's when you need the advice.
And I'm guessing it's not as simple as an online system as BM and a lot of the other lenders have got. Click a button and you've got an answer if it's a limited company.
I mean, we've made the transfer position a lot easier in terms of the exercise of what it is, but you have to take into consideration the tax position, because as a lender you might deem it as a remortgage, but of course from a HMRC perspective you deem it as a purchase, and in theory there's stamp duty to be paid there.
Okay, excellent. Please feel free to send any questions through as we talk, and we'll ask those as well. But moving on to new... Oh, sorry.
So, I was just going to say, on the limited company front, I think Adrian's talked that through really, really nicely. Just to reiterate, I'm not sure it's the right solution for everybody, for sure. We're still seeing a large amount of business being written on what I'll call traditional buy-to-let basis, and also pointing out that the tax changes have not impacted basic rate taxpayers. So depending on a customer's tax position, it's one of the options that are available. And depending on who you listen to, there are some commentators out there saying that 75% of their business is a limited company. That's a very specialist part of the market. So very important to get that specialist advice before getting into it.
So again, it's back to that point that it's not everybody that's going to be affected by those tax changes coming in. It's understanding each of your clients.
Yeah, never been more important to do that.
And so therefore, what sort of considerations are there now that are different between somebody new coming into the buy-to-let market as a landlord versus existing landlords?
I mean, I guess this has always been the case, but if you're an advisor, it's never been more important to understand a client's longer-term plans. Are they looking to build a portfolio, which is where the limited company proposition might come in, again, depending on their tax position. And I guess if you're an existing buy-to-let customer, Adrian's already alluded to this, it's not that simple to move into a limited company arrangement, so it'll only be right for the right customers. And again, I guess if you've got a large portfolio and you're an existing landlord, there might be limited remortgage options available, particularly if we move through to portfolio underwriting and some lenders decide that that's not an arena they want to play in. So it's going to become a very complex set of arrangements.
Adrian, anything to add?
Yeah, not really much more than what Phil said there, but I'd go back to the piece. This is a real opportunity for the broker community. 90% of buy-to-let mortgages already done through intermediaries. Advice now becomes even more key, and there are a lot more to choose for and a lot more consideration. So when clients come to you, you can really add value to the advice that you're giving them.
And we've seen the market obviously drop slowly since the tax changes or the stamp duty changes in April last year, so purchase hasn't gone back to that previous level. We saw a flux of remortgage at the tail end of the last year. Are we seeing that drop back off now? All the new rental calcs are in place?
I think what there was a rush at the end of last year before the PRA rules came into place, depending on when you went with the new rules. It's probably difficult for me to give a bigger gauge of what the market's like compared to Phil as a bigger player. I certainly think for the challenger banks and some of the specialists, they'll have probably chased a little bit of a lead by having, I guess, a more specialist offering than perhaps some of the mainstream players.
Phil?
Yeah, I think that's a really good point. You definitely see the market becoming more segmented. Adrian's mentioned it, the advice piece is key. There's a lot of customer choice out there. And the split between purchase and remo, you've probably found in the market now is certainly in excess of 70% remortgage. And the purchase business hasn't gone away. It's probably the smaller, less enthusiastic investor that's probably shied away because of the changes, whereas your serious investors are finding a way to incorporate the changes into their portfolios. And people haven't stopped buying either. If you look at the revenue from stamp duty, the quarter four revenue from stamp duty was the highest of any of the 3 quarters last year, which just indicates that people are still buying.
So do you think people are just taking that's a cost of acquisition now and just factoring it in?
Yeah, if they're a serious investor, they'll be factoring that into the overall deal for sure.
And are you seeing, because on our valuation business, we saw quite quickly after April a drop-off in southeast purchase, but it seemed to move north. So very much across that M62 corridor. Is that something you've seen as well?
Yeah, definitely seeing a lot of the traditional southeast investors moving north because of the rental calculations. And they're definitely having to be more picky about where they buy their property for sure.
Yeah, I mean, we've been quite London and southeast centric since the launch or relaunch of Kent Reliance. And we deployed 2 BDMs, one in the Midlands and one in the north last year, which has, I guess, increased our footprint up there. And we have seen more landlords looking to invest up in various areas. But what we've seen in London and the southeast is people, I guess, diversifying their investment line. Whereas maybe they would have bought a flat 2 years ago, potentially they're buying a house and converting it into multiple units or some form of HMO and lending to I guess, professional sharers. So we haven't seen a slowdown, but what we've seen is that investors are changing the type of property they're buying.
And with one of your other company heads on, are you seeing people move into the commercial market more?
Yeah, I mean, obviously we've got Interbay Commercial as one of our other brands out there, and certainly we've seen an increase in volume going into that, and people perhaps diversifying their investment. But again, it tends to be, rather than your habitual landlord who's getting into that market, is an experienced investor that looks at it.
And what type of property are they buying?
So semi-commercial seems to be quite popular in terms of, the shop and the flats upstairs. And we've also seen, I guess, some of the bigger HMO stuff that we do through the Interbay brand or larger blocks of multiple units.
So sticking with the core of it, there's people living in it rather than
yes, correct, yeah.
big commercial developments.
Correct.
Okay. And from a landlord point of view, are there any winners or losers, or is that just hype of people just trying to talk a market up or down?
I don't think it's hype. As I said at the start, there's been an awful lot of change affecting this segment of the market, probably more than I've seen even during the credit crunch. So it's certainly not hype. Adrian touched on this earlier on. Winners will definitely be mortgage advisors. There's a need for specialist mortgage advice, but there's no doubt that landlords have had, I won't say a battering, but they've had some challenges to contend with.
And I suppose we probably had a sigh of relief that the budget last week didn't have anything specific to us, but obviously there was a few mentions of self-employed and limited companies and tax evasion, so I suppose we'll have to see what the detail is on that before we know if it's going to affect the buy-to-let market.
Yeah, and I wouldn't rule out future change, but I was in a meeting recently that had some FPC representation. And it was good to hear the FPC acknowledging the amount of change that the market had been through, and that they called it a watching brief. So I certainly wouldn't rule it out, but I'd be surprised if there was any more major change in the short to medium term.
Okay. And looking at the lender side for a little bit, Adrian, will it become harder with all these new rules for new entrants to come into the market?
It's specifically for buy-to-let,
Yes.
Martin, I guess you're talking about. Well, I guess historically buy-to-let has been a good entry point if you're a new lender coming to market. I think you will still see some more come in there, but the parameters of what you can enter into now are much more tricky. So historically, perhaps you'd found a niche in criteria that you could push the boundaries with slightly, but of course, you know, the PRA and the FCA oversight there means it's quite difficult to do that. Is there still opportunity? There probably is, but would you see, I guess the difficulty is, depending on what you want in terms of volume, it might be hard to get some traction with some of the established players that you've got out there.
Yeah, I think it's one of those things where you should be careful what you wish for, because post-credit crunch, as you know, I was calling for competition for many, many years, and all of a sudden we've got so much competition that business is hard to come by. The good news is for consumers, there's lots of competition out there now, and I think the recent additions to market, we're probably looking at buy-to-let as a bit of an easy target. Some of them have got it really, just right. I mean, Adrian's business is a great example of a business that's done a really good job. Some of the others have found it a bit more difficult to get traction in a market that's becoming ever more difficult.
Is then, I presume it just becomes, if we're not careful, because you can't move along the credit curve or follow the PRA rules or breach them, it becomes a price game if you're not careful.
Yeah, I think pre the rules, we were already seeing some of the criteria boundaries getting pushed. And I'm sure it's those criteria boundaries being pushed that have caught the attention of the regulator in the first place. So we definitely need to be very careful we don't push too hard on criteria.
But because of that sort of flux that we're in there, do you think stop innovation then? Or is it the rules that will stop innovation?
No, I think, ironically, we're seeing lots of innovation, but it's almost innovation because we need to innovate. We're having to innovate because of the rules themselves, which in a way is a good thing, because it's forcing lenders to bring solutions to market that are consumer friendly. We've done our own, if you like, variety of changes in the last 18 months, but that's more because we've had to. So it could be stifling innovation, if you want to put it that way. I think it's more good to see lenders innovating because they have to.
Adrian?
I was really pleased to see that it wasn't a one-size-fits-all approach at the end of the year. Phil and his team at BM, they came out with bespoke calculators, so tailored to an individual's needs. You've got other lenders looking at the limited company market and the ways in which they can help people transfer over, if that's right. How far more can you go in terms of innovating? I think the next set of changes around the underwriting rules means it's more complex, probably more paperwork. I guess if anyone can innovate that and make it more automated, that would be the next big step.
Okay, so it's not necessarily products, it's process that could see the innovation.
Yeah, I think the other thing it's worth reminding the audience is all of these things take time. They take valuable resource, and a lot of the time they take a lot of money. If you take, Adrian's touched on it, thank you for the plug, by the way. Our tax solution was probably the best part of 12 months in the discussion and the build and the deployment, which took a lot of our IT resource and certainly a lot of capital to bring to market. And that's just one example. You go back to MCD, just to bring a consumer buy-to-let proposition to market in a big organisation like Lloyds Banking Group, again, was 12 months in the design and the build and the discussion, and again, a lot of cash.
I think it's the other bit, Martin, you've got to take into consideration, and it feels right there, in terms of the regulatory piece, that always has to take priority. So most of the lenders, if you're going to play ball in the portfolio landlord space, will be looking at how, when, and why they implement it for I guess, the 1st of October. Do they go early? What systems work does it take? What work does it take in the background? And of course, when you've got to land those changes as a matter of the regulatory piece, it means it's very often difficult to be creative and innovative.
Yeah. Do we think then, as intermediaries, we're going to have to get used to a bit more paper short term potentially while these solutions are rolled out, and that actually things aren't going to go through as quick as previously?
Well, I think you're already seeing that now in terms of segments of buy-to-let, as we discussed earlier, have become more complicated. There is more paperwork involved with those sort of transactions. And depending on what a lender's definition of proportionate is, post the 1st of October, if that's when they land, potentially it will mean more paperwork for brokers and clients alike.
I think, yeah, even for a lender like BM that's had an automated process for a long time, over the last couple of years, there are those applications now where we do need paper to support the application. and I think it's going to head even more down that direction. From my perspective, apart from the sleepless nights every time we see one of these changes, it's actually been a good exercise because it's forced our hand and made us look at new sectors of the market that we probably wouldn't have looked at historically.
I think it's interesting as well that there was quite a big hoo-ha about consumer buy-to-let
yeah.
and how it was going to happen, how it was going to impact, and within months it'd sort of been forgotten because of everything else that was coming along.
Absolutely, and I think a lot of that is because lenders deployed good solutions for brokers. But bizarrely, all we've really ended up with is another layer of complexity and regulation. It's been and gone.
And I think, to be fair, in the run-up to MCD, as I saw it, lenders were very good at signposting what was happening, what they were going to change well in advance. Do we think we'll see this in the autumn for the portfolio as well?
Yeah, I can, this isn't me saying that we're going to do portfolio underwriting, by the way. I can guarantee that if we bring a portfolio underwriting solution to market, we will go on the road as we've done with MCD and we did with tax changes and make sure brokers get the right level of education ahead of any deployment.
Adrian?
Yeah, I mean, we're well positioned for it in terms of the back end process. We manually underwrite all of our cases, which is, it fits in nicely with that model. I think the key thing is you wouldn't want to leave it to the last minute to when you launch it. So inevitably we'll be testing that and with brokers that are out there or people that want to have a look at it before we land it.
And do we think we'll get a spike in business as we have in all the other changes before?
I think you're already seeing that, Martin, because I think you're seeing those bigger landlords now who are well versed not just in the tax changes but what's on the horizon with the PRA or the secondary changes from the PRA, starting to look and think, will the process be easier now to move some of that stuff across? And as Phil said, about 70% of this market is refinance, and people are looking at the rates, taking the money out, and actually, while the process potentially from a paper-based exercise is easier, are looking to do it now.
Okay, and we have a question from Arthur Osborne. Do you envisage lenders' fees rising more over the next year to cover the increased costs as we move from sort of old to new changes?
So I guess by lenders' fees, we're saying product fees, arrangement fees.
And also rates as well, either or, I suppose.
Yeah. I mean, it's one of the options you're going to have to look at, I think, as a lender because of the increased underwriting experience you're going to need to see these deals through. I definitely wouldn't rule it out. But again, you've got to be careful because this is a market that's relying on competition. It's become a very competitive market. It's a bold lender that starts to put their fees up at the moment.
Is that because you potentially lenders might need actual more underwriters rather than the technology side?
Yeah, absolutely. Yeah. I think if we bring a solution to market, we will definitely need underwriters and experienced underwriters as well.
Yeah, I don't think it's a bad time to be an underwriter at the moment in terms of lenders wanting your skills. Phil's right. I mean, will product fees go up because there's more work? If there wasn't so much competition, potentially so, but I think there's a lot of lenders vying for business in either sector, in either position of the buy-to-let market, whether you look at the vanilla customer or whether you're looking at the portfolio landlord, and I think that will be one of the things that keeps prices down.
And sort of volume-wise, there's been a lot of talk, some people say 10 billion down, 10% down, 20% down, and we're roughly at about 40 billion last year, so would that be a bad thing if it dropped to 35, 36 billion this year? Would that still be seen as a good year?
Well, I think it would be a very good year, Martin, because I think that sort of drop will be exactly what the government and probably the PRA have outlined that they want to see in terms of share going down. I mean, still 1 in 5 households sit within the private rental sector, and it is a very important part of the UK housing market. But, if the market drops that, would it be a bad thing? I don't think it would be.
And I suppose there's a risk if it drops not enough, that there might be more government intervention. If it drops too much, they might panic and try and reverse something as well.
Yeah, I think it's an interesting point that Adrian's just touched on. There's a danger that we end up with a private rental sector that can't meet that gap in supply. Because at the end of the day, there is still a massive gap in housing supply. And I hope that the recent raft of changes will have done their job as far as the regulator's concerned and the government's concerned. If you listen to the doom mongers out there, they're calling a market of just over 30 billion this year, and the more positive amongst us will be saying it's certainly 35, 36 billion, which I think would be a good result for the market.
It's an interesting one because I suppose in my view, if you had the peaks that we had last year with dropping down potentially this year as an average over the 2 years, that's still a very buoyant market as far as I'm concerned.
Yeah, absolutely. It's still a market that's way off its peak back in 2007. What was it, 45, 46 billion market? But it's, again, back to your point, it's playing a very important part in filling that gap and providing good quality housing for some people.
And I think that's the thing, you're probably likely to see a much more professional sector. So, people will consider before they go into buy-to-let, they'll consider the implications, and actually, some of the larger landlords will continue to grow and will continue to benefit because they're better positioned in terms of acquiring the property.
And I suppose to start to wrap up, do we think that is hopefully the end of regulation for a few years? Do you think we might get a breather? I know that's a big question, Phil.
It's a very big question. I hope that we get a breather, and I hope for the sake of the market we get a breather, and it is back to that point. It's a very, very important part of the UK's housing agenda, and I think we're in danger of spoiling that very important part if we're not careful.
Adrian?
Yeah, pretty much what Phil said there. I mean, I'm not so sure how much more intervention or how many more rule changes can come, given what we've seen over a very short period of time. And as we talk back to the budget bit, no news was good news for the first time in this sector for a long time.
Yeah, and I suppose from my point, historically lenders for the last few years, because of MMR as well, have not been able to do a lot to their systems because it's always been about getting the new regulatory changes in. So I suppose if we don't have any for 12, 18 months after the autumn, it might allow lenders to be a bit more innovative.
Yeah, I think from my perspective, we are innovating. Our hands being forced to innovate, but that's a good thing. And I think just from an advisor's point of view, we've both touched on this earlier on, that there is a lot of opportunity out there. The remortgage sector of the market is buoyant. People are still buying. There's still a need for privately rented accommodation. And of course, if you're a lender with a product transfer proposition, there's still a lot of product transfer business to be written out there. So there are lots of good opportunities for those advisors who are prepared to get stuck in and educate themselves and write good quality business in this sector of the market.
Thank you, Will. Adrian, final words?
Yeah, I mean, just seize the opportunity. If we look back a few years ago, I think 70% of the market was done between two lenders. That's very much changed now. There's much more choice. There's much more knowledge that you can acquire as advisors that you can pass on to your clients. And, the opportunities are endless, really.
Thank you, Adrian. Thank you, Phil. Thank you, everybody, for listening today. As you can see, it's a complex market, but in some ways that's a positive because it means that clients need to talk to advisors like yourself. So thank you for being with us today, for sitting through the plethora of shows that we've had on this morning and early afternoon. They'll all be available on the media player over the next few weeks. Thank you for listening to us, and see you again soon.